My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramer. I'll be one of my friends, just trying to make a little money. My job, not just to entertain, but to educate, teach, explain. Call me, 1-800-743-CNBC. Tweet me, @Jim Cramer. Look, if you did well during the pandemic, it's almost a given that you're doing poorly in a post-pandemic world. It seems to be very hard to adjust to the new world, and it's leading to schisms in the marketplace that are getting, frankly, at this point, very hard for me to comprehend. This transition keeps wreaking havoc with the markets, including today. Dow dipped 151 points, S&P pulled back about 22%, and the Nasdaq declined. Well, no, I'd say that it was pretty flat, but at one point it was very ugly, nasty opening. Sometimes the COVID hangover is so obvious. And last night, Zoom Video reported, and it reported another huge disappointment. One in a long string of many since the vaccine started kicking in. This pandemic darling, a name that became kind of like Kleenex in terms of a verb or a damn, whatever, you know, like a familiar thing, just can't seem to get beyond itself. While press reports indicated the consumer business was weak, a lot of people thought the enterprise business was hanging in there. No. In reality, Zoom's getting smoked by Microsoft Teams. Because Microsoft's a really vicious competitor, just don't seem like it. But what's most alarming about Zoom's miss is they don't seem to realize what's wrong. It's almost existential. The pandemic is really waning. And aside from some exceptional situations, you almost never say need to wear a mask. Yet the Zoom people seem to act as if we're still hunkered down in our homes, wearing masks as we hide from COVID germs that lurk at the office and on every plane. Nothing could be further from the truth. Now, you could say they have no choice. Zoom is Zoom. I mean, what else are they going to do besides Zoom? Right? I mean, they Zoom. I say they've got $5.5 billion in cash. Why not try to reinvent yourselves at least? Sure, I know they tried and failed to buy Five9, the contact center software play, but that was over a year ago, and they haven't tried anything else since. Again, you could argue there was nothing out there that could fit Zoom's core competency. Who's Zooming who? But, man, there are literally hundreds of venture capital-backed businesses that are devoted to innovative software that would dovetail into the house of Zoom. Or they could just at least look for some important partnerships. I got an idea. Why not collaborate with DraftKings to have video gambling on events where you play me or I play you or we play against each other in a group of people? In the end, the decline and soon fall of Zoom is a stunning failure not of the company's original product, which was great, but of the inability to imagine something bigger or at least a fallback plan if the all-stock deal to buy Five9 collapsed. Something that became pretty obvious as its stock fell badly and Zoom refused to pony up cash to make the deal work. Of course, they're not alone. I don't want to just blame Zoom. I mean, how about DocuSign? The outfit that allows you to sign contracts digitally rather than in person has totally failed to become more than its old self, even though it's sitting on a bill with cash. There are so many ancillary identity and cybersecurity deals these guys could have done that it is just painful. Where does it say that DocuSign has to be DocuSign or Zoom has to be Zoom? Hey, look, I'm not asking them to become conglomerates overnight, but after last night's painful Zoom conference call, it does seem that all Zoom wants to be is Zoom, and all DocuSign wants to be is DocuSign. It's been more than 2 months, and they still have no CEO since Dan Springer unceremoniously stepped aside. Somebody could easily step in and reinvent this thing as a consumer-facing service company with all sorts of security options to go with the signing. But no, it languishes, a casualty of the same thing that made its stock skyrocket 2 years ago. These guys have no imagination. Now, those are the well-known disappointments. I mean, I throw in Peloton, too, but they don't have enough money to reinvent themselves. However, it's the secondary post-pandemic losers that are really frustrating to me. Take one of my old favorites. Take the stock of Clorox. Now, here's a company that was given a cash cow, right? An injection of consumer wealth, a virtual COVID handout. And all that has happened is that its cash position has declined from $871 million in 2020 to $183 million now Market capitalization has gone from $22 billion to $18 billion, even as they haven't done anything to make the balance sheet better. Surely Clorox could have used that wipes windfall to double or even triple the size, say, of Burt's Bees line of natural products. At a minimum, how about buying e.l.f. Beauty, the cosmetics company that's doing so well in Ulta? They've got a lot of natural and organic products. Hey, what a terrific compliment to a business that's going nowhere. I got an idea. How about purchasing Utz to expand the Hidden Valley Ranch franchise? Or why not sell the Hidden Valley Ranch franchise entirely? I know a lot. And McCormick could probably buy them. And move into an area adjacent to Kingsford's Charcoal. I've got one, Traeger, symbol cook. You can buy a grill company for next to nothing right now, then expand into wood pellets. This is not rocket science. It's just an acknowledgement that there was a windfall, and you better do something with it or your stock will languish. I really like that Traeger idea. Come on, that's good. Well, I can't really hear you at home, but I know you're nodding. All right, then there's a whole other group of companies that seem to not get it. Take the rails and the airlines, okay? I mean, honestly, let's focus on these. Now, the rails and the airlines, they're boom-bust businesses, always have been, where they're used to hiring people and then laying them off, depending upon the vicissitudes of the economy. They laid people off well during the downturn. Oh, but somehow, dumbfoundedly, they keep waiting forever for those people to come back rather than aggressively finding new hires. Now, if you're in the airline business, is it that hard to recognize that we're very short pilots? I mean, perhaps as many as 10,000 of them, and now mechanics? Why can't they face what's happening and get on with it? Private training and reinvention, come on! And why do they keep hoping the old pilots will come back rather than understanding that it's not happening and start doing the poaching and the retraining? And don't tell me these people can't be found. Take the hit. Pay much more. That's the real issue, isn't it? And move on. What else? As I listen to these retail conference calls, I'm stunned that so many of them think our taste in clothing has permanently changed thanks to COVID. But nothing's permanent in the apparel business. We indeed dress down during the plague, but now we dress up and go out. We want to put COVID behind us, for heaven's sake, not look like we did during COVID. We don't want to put schmatas on for a fancy meal. Don't you know that? These companies listen to each other's conference calls. I mean, shouldn't they know better? Certainly, there are some tense moments. Who's coming to work? Who's staying home? Who's working 3 days a week? Who's working no days a week? I mean, I get all that. That's in flux. But at this point, I would say those situations are getting pretty few between and far between. Most people have moved on to other pastures if they don't like their company's work-from-home philosophy. Some enterprises totally get it. I think Cisco's in breakout mode now. It's getting the chips it needs to become flexible enough to accommodate remote work. It helps that they're a very accommodative company when it comes to where you get your work done. When I listened to the Palo Alto conference call or talk to the brilliant CEO Nikesh Arora on the show last night, I remember that he was the first CEO to see things were never going to be the same. And his cybersecurity company adjusted and capitalized off it. No wonder his stock jumped 61 points or 12% today. The automakers, they've been able to take the next step. I'm sorry, they haven't been able to take the next step. You know why? They didn't understand their own supply chains. They hadn't figured out how they actually built new digitized cars. They were like from some sort of analog world. They couldn't predict how the semiconductor market was going to be changed by the chip makers that only cared about video games and high-performance computing. By this point, they could have built their own semiconductor foundries themselves to solve the shortage. They're still paying the price. We know it hasn't been long since the pandemic effectively ended, but we're so quick to fault the Fed for providing too much liquidity or Congress for doing too much deficit spending. The truth is, we'd be in a much better situation if the private sector had been proactive about transitioning to a post-COVID world, and they really haven't done a good job. Still, the bottom line is that it's not too late for some of these outfits, like Zoom, that are sitting on big piles of cash to reinvent. They just can't seem to point the camera at themselves and see the truth. I say we go to Ann in Indiana. Ann!
I'm a club member. I love it, Jim. Thanks for all you do.
Oh, you're so kind. Thank you.
So I have some deep in the money call options on Twitter. I've trimmed on the way up. Am I, in a perfect world, just waiting for my catalyst of a settlement or Twitter winning their lawsuit?
I'm glad you brought it up. First of all, thank you for remembering the club. The club is very hot right now. We're doing a lot of new things. I urge everyone to trial it. You won't believe all the things that come with it. It's not just an email. But I will tell you that Twitter's now down all the way to 39, in part because of this whistleblower that we read about today, and I would not sell it at this point. I think there's 9 points downside and 15 points upside, and that is enough to be compelling. I just don't think that it's worth it, $39 to sell Twitter. But I do thank you for the kind words. Again, 9 down, 15 up. Right? We're very quick to fault the Fed for providing too much liquidity or Congress for creating too much money during the pandemic. But we would be in a much better position if more companies have been proactive about transitioning to a post-COVID world. I want to be sure people understand. At $39, you really got 12 on, okay? I don't want to make it sound like that you're going to go above the offer. It's not. On Mad Money tonight, investors are starting to fear that this market is shaping up a lot like 2001, 2008. Those were very bad years. So do the comparisons hold any weight? I'll give you my take. Then what could jobless claims tell us about the trajectory of the market? You might think nothing, but I'm going to go off the charts and you're going to learn otherwise. And you called in and stumped me on a company called Adcore. I'm turning in my homework on the stock to see if it could present an enticing buying opportunity. And I got to tell you, it's pretty darn sweet. So stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.